The future of money crypto. Cryptocurrencies are changing how we think about money. Bitcoin, Ethereum, and others are becoming popular. More people are interested in trading crypto. This is especially true in America, the UK, USA, Canada, New Zealand, and Australia. But trading crypto can be risky. This essay will help you understand crypto trading indicators. These indicators can help you make better trading decisions. We will explain key indicators in simple terms. We'll also discuss the benefits and risks of crypto trading. Charting the course. Understanding indicators. Imagine a map for navigating the crypto market. That's what trading indicators are. They are tools that use past price and volume data to help you predict future price movements. These indicators are visually represented on charts. By learning how to read these charts, you can get a better understanding of market sentiment and potential buying or selling opportunities. Moving averages, smooth sailing, or choppy waters. Moving averages are like smoothing out the ups and downs of a bumpy road. They show you the average price of a cryptocurrency over a specific period. This helps to filter out the noise and see the overall trend. For example, a 50-day moving average shows the average price over the last 50 days. If the price is consistently above this average, it might indicate an upward trend. RSI measuring the pulse of the market. The Relative Strength Index, or RSI, is like a thermometer for the market. It tells you if a cryptocurrency is overbought or oversold. An RSI above 70 might suggest it's overbought, while below 30 might mean it's oversold. Traders use RSI to identify potential trend reversals. For example, if a cryptocurrency has been on a strong upward trend and the RSI hits 80, it might be a signal to take some profits. Section 5. MACD, spotting momentum shifts. The Moving Average Convergence Divergence, or MACD, is a bit more complex. It helps you identify changes in momentum. It uses two moving averages and a signal line. When the MACD line crosses above the signal line, it can indicate a bullish signal and vice versa for a bearish signal. This indicator is often used to confirm trends and spot potential trend reversals. Section 6. Benefits and risks. A balanced perspective. Using trading indicators can offer several benefits. They can help you make more informed trading decisions. They can also help you manage your risk by providing insights into potential market movements. However, it's crucial to remember that indicators are not foolproof. They should be used in conjunction with other forms of analysis, such as fundamental analysis, which looks at the underlying value of a cryptocurrency. Section 7. Practical tips for crypto trading. Start small and don't invest more than you can afford to lose. Diversify your portfolio by investing in different cryptocurrencies. Choose a reputable crypto exchange with high security and low fees. Remember, crypto markets are highly volatile. Don't let emotions drive your trading decisions. Stick to your trading plan and manage your risk carefully. Section 8. The importance of a solid strategy. Having a well-defined trading strategy is crucial for success in the crypto market. Your strategy should outline your entry and exit points, risk management rules, and the indicators you'll be using. It's also essential to backtest your strategy using historical data to see how it would have performed in the past. This can help you refine your approach and improve your chances of success. Section 9. Conclusion. Navigate the crypto sea with confidence. Crypto trading can be an exciting and potentially profitable endeavor. By understanding and utilizing trading indicators, you can gain a valuable edge in the market. Remember to approach trading with caution, manage your risk effectively, and continuously educate yourself about the ever-evolving world of cryptocurrencies.